Bond market volatility collapses to a record low. All kinds of activity can reflect extreme enthusiasm for financial assets, from stock buybacks to repealing government regulation to what the public worries about. Yet here we have extreme enthusiasm as measured, so to speak, by non-activity. This graph is the Merrill Lynch Option Volatility Estimate, or MOVE Index, which shows implied volatility for short-term U.S. Treasury options. The timeline includes 2007 through the present. Highs on the graph are peaks in implied volatility, lows are troughs in implied volatility, and the lows, or relative absence in future expectations of volatility, is the non-activity we have in mind. At a glance, you can see how major lows in implied volatility tend to precede fast upward rises in the MOVE Index. Yet this measure and its implications go from interesting to wow when we fill in a few important points along the timeline. Here, this 2007 low in implied volatility was in fact the price peak for many financial assets, and it marked the start of a very volatile period for Treasury bond prices. If you were there, you remember. In turn, the MOVE Index soared like a rocket into late 2008. Jump forward to July 2016 when implied volatility was declining, which coincided with a long-term peak in bond prices. This January 2018 low paralleled the all-time high in the NYSE Composite Index and a rapid decline in bond prices. Which brings us to the present, actually about 2 weeks ago, to this low on March 20th. Implied volatility fell 42.53, the lowest low in the 31-year history of the MOVE Index. Another way to put it is record complacency toward the potential big move in bonds and interest rates. And note too how, right on time, the record low was immediately followed by this upward spike. Periods of low volatility always precede periods of rising volatility. Stay tuned.